IUL has likely been a mystery to you, and you likely have heard that it's a retirement savings vehicle and you'd like more information about it. One trend we've seen since the last big recession is using an IUL contract as an alternative to a 401k. If you would like to help boost my ranking in YouTube search results, please give me a thumbs up and subscribe. That would help me out a lot. Because IUL takes advantage of IRS code 7702, which defines what the federal government considers to be a legitimate life insurance contract and is used to determine how the proceeds are taxed. IUL will give you tax-free growth on your retirement savings, tax-free income in retirement, protection from stock market crashes, market-like returns, easy penalty-free access to your retirement savings, and the ability to act as your own financing company for major purchases and investments. Before I start addressing what Index Universal Life Insurance is, it's important you understand what indexing is, since this is an index product. Would you rather be invested in the red line or the green line? The red line is the market strategy, or the S&P 500, your 401k, 403b, or your IRA. And the green line is the index strategy, where you make market-like returns, but you're protected from stock market downturns. So let me explain how indexing works. You choose an index like the S&P 500, for example. Your money is not invested in the index, so it's not in the stock market, but you get the return based on the movement of the index. Your money grows however the index performs, up to a limit or a cap, let's say 12%. Now, if the market grows 15%, your money will only grow up to that 12% cap. But the trade-off is complete downside protection from market losses. So just like you would have a cap, you would also have a floor of 0. So the worst thing that could happen is you get 0 interest in market downturns. In other words, you lose nothing ever. So let's look at this chart again. You can see how volatile the market was between 1998 and 2013. You can see where I circled in blue that when the market goes down, you get 0 growth because of the floor. This is a comparison of market strategy and the indexing strategy. At a 12.5% cap with a $100,000 balance over the last 20 years, if you would have just gone to sleep and put your money in the S&P 500 index, you'd have $153,000 more in your account with a cap and a floor than you would just writing it out. There are 3 vehicles available to get a tax-free income in retirement: a Roth IRA, municipal bonds, and permanent life insurance. In this case, in the form of fixed or indexed universal life insurance contracts. The differences between the 3 are risk, contribution limits, age restrictions, returns, how your money grows, income, required minimum distributions, or RMDs, fees, funding, access to your money, death benefits, and living benefits. An IUL contract has no risk to stock market downturns because it's an index product with a ceiling and a floor, so 0 risk. No annual contribution limits, no age restrictions, easy and penalty-free access to your money, market-like returns, your money grows tax-free, you get a tax-free retirement income, no required minimum distributions, you get a death benefit and living benefits, and limited fees only if it is structured properly. And by saying that, you really do have to be careful because, first of all, very few agents are trained on how to structure these innovative policies to optimize the growth of your money. Or they do, and they'll actually structure these policies to optimize not your money, but their commission. So be very careful. Now, unlike an annuity, you cannot roll over a 401k or any other qualified money into this account unless you pay the taxes on your qualified funds first. So you would commit to a monthly or annual premium. And if you want to supercharge your policy, you can contribute a lump sum up front. You may be asked to complete a health examination as part of the application process with the IOL. One of the key benefits to owning a universal life insurance policy is the ability to access funds from your policy's cash value without having to pay taxes on it. If you have or are thinking about buying an index universal life insurance policy, it's important to understand loans and how they work. So let's get into it. When you take a participating loan, your money never leaves your policy account. It continues to earn interest. So you earn interest on the money you loan yourself. Now you're charged interest for borrowing it, but the interest you're getting on that money far offsets the charge. Now the greatest difference between policy loans and traditional loans is that you don't have to pay back the loan to your insurance policy. When you borrow based on your life insurance policy's cash value, you're actually borrowing from the life insurance company, and the cash value of the policy and the death benefit are used as collateral. If you don't pay back the loan, the insurance company will take it from the cash value of your policy or deduct it when the death benefit is paid out. The death benefit is simply reduced by the amount of the outstanding balance. And you're probably thinking, well, that's just too good to be true. But the death benefit is the guarantee that is backed by the claims paying ability of the underlying insurance company. Now, all that being said, it's important to note that an IUL policy loan and withdrawals will reduce the available cash value and death benefit and could also cause your policy to lapse. Let's say you have $100,000 in cash value in your policy and you decide to take out a $20,000 policy loan to buy a new car. Let's say the insurance company charges you 5% on the loan and the market went up 10%. That loan didn't cost you anything. You actually made 5% on the money you loaned yourself. Now, how does it work when you're taking distributions as tax-free retirement income? So let's compare income from a 401k versus an IUL. Take a 65-year-old who wants a $97,000 annual income in retirement. With a 401k, he has $858,000 in retirement savings. He withdraws $129,340, knowing he'll have to pay $32,335 in taxes on that withdrawal in order to get his $97,000 income. This poor guy will run out of money in 9 years at the age of 74. Now, the 65-year-old with the IUL has $709,000 in retirement savings, which is roughly $150,000 less than the other guy. He takes his $97,000 annual income in the form of a loan, tax-free, and keep in mind, he keeps earning interest on the loans that he's taking for his annual income. And he has $864,000 life insurance death benefit. If he dies at the age of 100, he would have received $3,395,000 in income, and his family receives $3,036,000 in death benefit, all income tax-free. The other benefit he has that the 401k guy doesn't have is living benefits. Because this is a life insurance policy, you actually have access to the death benefit tax-free while you're alive in the event you have a chronic, critical, or terminal illness. And it also allows the death benefit to be distributed before death to pay for long-term care. Now, we're going to get into the guts of the proper way to structure an IUL for maximum cash accumulation. There are two ways you can structure these. The traditional way, which has a really bad reputation because of high fees, high costs, and high commissions. Traditionally, they were sold as a very expensive insurance policy that made agents big commissions. So as you can see, the bulk of your money here goes to insurance costs, and your cash value is minimized. The death benefit is what drives the fees, commissions, and the cost of the policy higher. There are some stark differences between the traditional way and what can actually be done if you know what you're doing. You flip this concept upside down. You maximize the cash value in your IUL, and you minimize the insurance cost. Structured this way, it reduces the administrative costs for your insurance because your death benefit is lower. So the commissions paid to an insurance agent are lower. So when you hear Dave Ramsey, Susie Orman, your financial advisor or CPA or brother-in-law saying these policies are expensive and not a good investment, they're talking about the red bucket over there. So let me give you a hypothetical situation of a 45-year-old man putting in $20,000 a year. I'm going to pull back the curtain and show you how the same amount of money going in can have a dramatic difference in your retirement cash flow and the commission your insurance agent would make. If you were to use a typical structure like the red bucket with a level death benefit and no cash optimization, and this 45-year-old man is putting in $20,000 per year for 21 years, at age 65, he's going to have $523,000 of cash value, a $1.5 million death benefit throughout the life of the contract, and the agent who sells that is going to make a $27,000 commission. So the guy's putting in 20, and the agent's making 27. That's a pretty good size commission, right? So this is the way these policies were traditionally structured. Very few agents know how to structure an IUL for maximum cash accumulation. You can use cash maximization and still use a level death benefit, and it improves your cash value significantly. Now get this. You lowered your death benefit by $500,000, and look what that did to your cash value. It increased it by $141,532. Did you put any more money into this? Nope. Same amount of money, different structure. And look at what the agent gave up in order to give you $141,000. That's about $8,000. So doing it this way, it cost the agent $8, but made you $141. Do you think it's right for an agent to cost you $141,000 in order to put another $8,000 in his own pocket? No, and I don't either. It's criminal as far as I'm concerned, and that's why I don't build these policies this way. Now, there's one more thing you can do if you know what you're doing, and that is to use an increasing death benefit. And this is where it gets extremely efficient. You start with the lowest death benefit the IRS will allow, and you step it up each year as your cash value grows. This drops the death benefit another $644,000. So from the first to the third, we dropped $1.1 million off the death benefit, and look what it has done to the agent's commission. It's cut the commission $20,000 overall. Let's see what it does to your cash value. So you've gone from $523,000 to $811,000. That's almost $300,000. And again, did you put any more money into this policy? What's the only difference? Well, it's using somebody who structured it right and knows what they're doing. Kaizen is an IUL on steroids. Kaizen is a unique retirement plan that will increase your retirement distributions by 60 to 100% using leverage, where a lender matches your 5 annual contributions 3-to-1 at LIBOR plus 1.75%. This is not a gimmick. It's a legitimate strategy that up until recently has only been available to the ultra wealthy, but now is available to those with an annual income of at least $100,000 who are in good health and no older than 65.
Here's how Kaizen uses leverage in a very different way. Your contributions are matched by the lender for the first 5 years. Then, the lender uses that as security for the additional funds for the next 5 years. The contributions are used to fund a cash accumulation life insurance policy. A minimum amount is used to purchase the death benefits, living benefits, while the majority of the cash is used to maximize your potential tax-advantaged growth. What could be better? Would you rather have this in retirement, or the potential for 60 to 100% more retirement income with Kaizen? Secure your lifestyle with Kaizen. More money, more protection, more confidence.
The benefits of an IUL over a 401k are undeniable. If this is of interest to you, and you would like me to prepare a customized IUL illustration for you, please complete the application below. And of course, please give it a thumbs up and subscribe. And after you subscribe, just hit the bell to be notified every time I upload a new video.